I've been quite surprised by just how significant the decline in rig count has actually been over the course of the last 12 months. What does that mean in terms then of how far out any recovery in supply comes to the market on the basis of higher prices?
Well, what's interesting, because when we published our outlook, we called it the Great Reset, and we talked about the fact that if it wasn't for COVID-19, we wouldn't have seen such a reset on supply as we have done, particularly in the non-OPEC, non-US piece. And that's important because a lot of analogies to 1998 were being made on oil, where you just see this sort of sluggish demand and you see relentless supply coming from somewhere. So thanks to COVID-19, one of the silver linings is that we've seen a lot of that redundant supply or high marginal cost being sort of laid to rest. What we have now is a serious situation where we have a large deficit emerging on the horizon. We've talked about this for our supercycle thesis, and that will occur within the second half of this year into next year. We forecast a 4 million barrel deficit by 2023, which, if untreated, in as far as capital not returning, as we're starting to see with shale, because people are much more wary of returns, then we could see oil prices overshoot extensively within the next 12 to 18 months. And just as we saw oil prices go negative, we could see oil prices overshoot positively as well.
Christyan, one of the big moving stocks on Wall Street yesterday was ExxonMobil, and that was thanks to one of your colleagues in the States upgrading the stock for the first time in 7 years. It was interesting to see the reasons around valuation. The past was one of the stumbling blocks. Also, capital discipline had been holding back that upgrade. Is there a read across to other stocks in the sector?
Absolutely. In fact, one of the things that we've seen through the corporate lens, we've talked about the Great Reset at the macro level, but at the company level, we've seen capex reset, dividends reset. So again, if it wasn't for COVID-19, you wouldn't have cash break-evens, which is the oil price needed to cover your capex and your dividend. Now they're down at $35. And that affords the ability for companies to start raising their dividend and or buybacks. Quite a U-turn from last year, where everyone was asking who's going to be the first to cut. This year it'll be who's the first to raise the buyback. Within that context, we're looking for the UK names Shell and BP as the companies to lead the charge, having cut the dividend. They are much healthier for it, and with plenty of free cash flow, particularly at these oil prices, and with demand recovering, we'd expect them to be first out the door to raise the dividend. And sort of the parallel to Exxon is that Exxon does have the highest dividend per cash flow, and it has one of the highest cash break-evens, which makes it more pro-cyclical. But given our bullish view on oil, you want to be exposed to higher beta and those that can give dividends.